Well, there's three major categories that we look at. One is your credit score. The second is debt to income ratio. So when you're computing debt to income, you want to take the debt payments. The best place to think of where to find those is on your credit report. Major categories would be, mortgage on your current home, auto payments, student loans, installment loans, credit card payments. So you want to add all those up. Now, if you're selling your current home before the end of the construction loan, we will omit the current home mortgage. So you can take that out. But anyway, that's how you come up with your debt. On the income side, it's your gross income. If you're a W-2 earner, we'll look at the base pay from the last 30 days. If you have any type of incentive pay, like commissions, bonus, overtime, then you have to have earned that at least 2 years in order for it to be eligible. We'll take the average over the last 2 years. So that's how you get the income side. And then that debt to income ratio needs to be no more than 43%. So if you are as I said, if you're a W-2 earner, then you just take the income as I just mentioned, and you can include that incentive income. Now, if you have your own business or investment in a business, then you'll use the net income from that business. You can add back depreciation. So you just want to go to we'll look at the last 2 tax returns. Unless the more current tax return is lower, then we use the most current tax return. It's basically the bottom line reported tax return income, adding back depreciation. Then any other sources of income can also be eligible. VA benefits, child support, Social Security. The list is endless. If you're getting a constant stream of income in the future and you can prove that you'll be getting it or should be getting it. The last category is loan to value. We want the loan to value to be no more than 85%. So basically what it really means is you need 15% down. So on a construction loan, you want to have, we're going to need 15% down plus closing costs. So the big question people ask is, where can that down payment come from? Obviously, you can put cash down, but you can also use equity in the land. So we'll look at whatever the value of the land is, less any debt against it is equity in the land. We can also use equity in your current home, as long as you're planning to sell the home before the end of construction. So you got 3 sources of where you come up with the down payment.